Good morning, sir. Good morning, classmates. Our topic for today is all about the arbitrage pricing theory. Before I will start my report, I give you one question about the arbitrage pricing theory. Why is arbitrage pricing theory important? Okay. This the theory which is helping the investors and analysis in finding out a proper multi-pricing structure and model for the asset security based on a relationship that the expected returns of the assets have with the risk. So, the arbitrage pricing theory is one of the tools used by the investors and portfolio managers. The capital asset pricing theory explains the returns of the securities on the basis of their respective betas. According to the previous models, the investors chooses the investments on the basis of expected returns and variance. The alternative models development in the assets pricing by Stephen rules is known as the arbitrage pricing theory. The ATP theory explains the natures of equilibrium in the pricing in a less complicated manner with a fewer assumptions compared to COMP. Have three assumptions of the arbitrage pricing theory. The first is the investors have homogeneous expectations. The second is the investors risk averse and utility maximizers. The last is the perfect competitions prevails in the market, and this is no transactions cost. Next is the ATP theory not assumed. First is the single period investments horizon. The second is no taxes. Third is the investors can borrow and lend of rich free rate interest. The fourth is the selections of the portfolio is based on the mean and variance analysis. Okay, so next the arbitrage portfolio. Arbitrage portfolio is a portfolio with a zero factor risk, that is, all the factors sensitive are equal to zero and the portfolio requires no capital invested. Furthermore, is the market is efficient, the return on the arbitrage portfolio will be zero. Example of arbitrage portfolio. Example of ATP. The following four factors have been identified as explaining stock return and its sensitivity to each factors and risk premium associated with each factor have been calculated. First, the gross domestic product or GDP growth sensitivity equals 0.6, risk premium is equal to 4%, the inflation rate sensitivity equals 0.8, risk premium is equal to 2%, the gold prices sensitivity equals negative 0.7, the risk premium is equal to 5%, the Standard and Poor's 500 index return sensitivity equals 1.3, risk premium equals 9%, the risk free rate is 3%. Using the ATP formula, the expected return is calculated as expected return is equal to 3% plus 0.6 times 4% plus 0.8 times 2% plus negative 0.7 times 5% plus 1.3 times 9% is equal to 15.12%.
more fully for the decisions that producers and consumers make. Can you remember the last time that you visited a business and wanted to make a purchase, but decided against it because you thought that the price was too high? Or how about deciding to make an impulse purchase because you felt as if you were getting a pretty good deal price-wise? If you experienced either of these scenarios, then you understand that prices have a major effect on producers and consumers and the decisions that they make.
Effect on price is a concept that looks at the effect of the market prices on consumers' demand. The price effect can be an important analysis for businesses in setting the offering price of their goods and services. So, sabi dito na ang price effect ay isang important analysis wherein kung nag-put up ka ng isang business, the offering price of their goods and services. So, dito natin maipapakita kung ano talaga yung ma-offer natin na price sa ating mga paninda or sa ating mga goods and services. So, in general, when prices rise, buyers will typically buy less and vice versa when prices fall. So, pag tumaas ang prices ng products, bumababa ang demand wherein kaunti lang ang bibili. Kapag ang prices ay bumababa, tataas ang demand at dadami ang bibili. For example, if the stock C at price 100 per share have earned 12% return, at 80 per share, the return would be 12 divided by 80 times 100 is equal to 15%. So, to buy stock A and B, the investors has to sell stock C. The buying pressure of stock A and B would lead to increase in their prices. Conversely, selling of stock C will result in fall in the price of the stock C. With the low price, there would be rise in the expected return of stock C. At the same time, return rates would be declining in stock A and B with the rise prices. This buying and selling activity will continue until all arbitrage possibilities are eliminated. At this juncture, there exists an approximate linear relationship between expected returns and sensitivities. APT model or the Arbitrage Pricing Theory model is a multi-factor asset pricing model based on the idea that an asset returns can be predicted using the linear relationship between the asset expected return and a number of macroeconomic variables that captures systematic risk. So, it means dito na ang APT model or the Arbitrage Pricing Theory model is isang multi-factor wherein they are predicted using the linear relationship that captured systematic risk. So, asset pricing model consists of estimating asset expected return through its risk premium linear relationship with factors portfolios, expected risk premiums, and macroeconomic factors. So, according to Stephen Rose, return of the securities are influenced by the number of macroeconomic factors. So, sabi niya dito na ang returns of the securities ay isang influensya by the number of macroeconomic factors. So, what is macroeconomic factors? Macroeconomic factors are growth rate of industrial production, rate of inflation, spread between long-term and short-term interest rates, and spread between low-grade and high-grade bonds. The arbitrage is represented by the equation. Expected asset return through arbitrage pricing theory model is equal to risk plus B1 coefficient multiplied by market risk premium has the difference between the expected market return minus risk return plus B12 coefficient multiplied by the macroeconomic factor. In this case, clearly, educational example, therefore not fixed, can be modified. We have to expect change in CPI. CPI is Consumer Price Index, and the change in CPI is considered inflation with positive and deflation in negative. Plus the expected asset access return through corresponding arbitrage theory model. The beta coefficient in the APT model or the arbitrage pricing theory model are estimated by the linear regression. In general, historical securities returns are aggressed on the factor to estimate its beta. Arbitrage pricing theory model formula has multiple factors, and it takes a considerable amount of research to determine how sensitive a security is to various macroeconomic risks. The factor as well as how many of them are used are subjective choices, which means investor will have lying result depending on their choice. APT factors or the arbitrage pricing theory factors are the systematic risks that cannot be reduced by this diversification of an investment portfolio.
Arbitrage pricing equation, the linear relationship between return and sensitivity. So here is the form. Return from stock A is equal to uh, riskless rate of return plus slope of the arbitrage pricing line and the sensitivity related to the factor. The risk is measured along the horizontal axis while the return is on the vertical axis. The ABC stock are considered at the same risk class. Then the riskless rate interest intersect the y-axis. And the slope of the arbitrage pricing line, it indicates market price of risk and measures the risk return trade-off in the security market. The risk-free asset yields a risk-free rate of return, and the asset does not have sensitivity to the factor. For example, uh, the the if the sensitivity related to the factor is equal to 0, then the return is equal to riskless rate of return plus slope of the arbitrage pricing line. And then the return is equal to riskless rate of return. So let's move on. Factors affecting the return. According to Chen, Roll, and Ross that have taken 4 macroeconomics variable, the factors are inflation. It affects the discount rate or the required rate of return and the size of the future cash flow. In short-term, inflation affects the consumer price index. The interest rates of long-term and short-term bonds affect the value of payment in the future relative to short-term payment. Yun, sir. High-grade and low-grade bonds indicate the market reaction to risk, but the low-grade bonds are more risk. Change in the industrial production have an impact on the expectation and opportunities of the investors. Burmeister and McElroy have estimated the sensitivities with some other factors. One is default risk, time premium, deflation, change in expected sales, the market returns not due to the first 4 variable. So the default risk, return on long-term bond issued by corporate plus 1/2 of 1%, and the time premium minus 1 month treasury bill o 1 month ahead. In the deflation, expected inflation at the beginning of the month minus actual inflation during the month. While Salomon Brothers identified 5 factors in their fundamental factor model: inflation, growth rate in gross national product, rate of interest, rate of change in oil prices, and rate of change in defense spending. So the inflation is the only common factor identified by others. Also, rate of interest is common factor. Thus, the stock price is related to aggregate economic activity. So, what is similar to the CAPM model? It is. APT is more general and less restrictive than CAPM. The APT also based on the law of one price to hold for all possible portfolio combination. The macroeconomics is closer to reality than CAPM. The market portfolio is well defined conceptually. In APT, factors are not well specified. CAPM leading to the wide usage of the model in the stock market, so most of them are likely using CAPM model. The impact on one group of securities may not affect another group of securities. Kunwari, nakagawa ko ng mali. Hindi ko yun i-share sa ibang group para hindi sila maapektuhan. And gagawin ko yun agad ng solusyon. So, further, the influence of the factors are not independent of each other.